Well, thank you, Lemma. It's great to be here with all of you. Hope you've gotten your coffee. I'll try to keep you awake if you didn't get your coffee yet, but we have some things to talk about. So I've given my remarks the title, Measuring and Managing Systemic Risk. That's because with an audience like this, I changed the title. At one point it was called How to Avoid the Next Financial Crisis. And I decided that was a little too ambitious for today. But it's our goal, of course, and it's one of the things we want to see what we have to say about. So we've been studying the financial crisis at the Stearns School for a couple of years, and this led to the unheard of idea of 30 faculty collaborating on writing a book, which is about the financial crisis, which received very good reviews. And because that was so much fun, we wrote another one, which was like Terminator 2, on regulating Wall Street, which was released a year ago. And actually, there's still one that's recently come out on the GSEs. But in any case, what is the summary of these thick, heavy volumes? Well, one of the things that's a summary, I think, is the idea that we've learned from looking at the financial crisis that the failure of large, complex financial institutions can have disastrous effects on the global economy, leading, of course, to the rhetorical question, should we have rescued such firms, and should we have rescued laymen? If firms count on being rescued, of course, they will take on too much risk. So the choice of rescuing or not leads to one section of the Dodd-Frank bill, which was on resolution authority. But my view is no matter how good your resolution authority is, you'd rather not to test it. It's sort of like being up in an airplane with a new kind of parachute. And you say, you know, I wish I had a third choice. And the third choice, of course, is what we're talking about, which is regulation. Can we regulate the risk of institutions that are too big to fail or systemically risky and avoid the, at least with high probability, the dilemma as to whether or not to rescue these firms? So a particular definition of systemic risk is that we like is the Tarullo definition, which basically talks about firms failing to meet obligations. And if they fail to meet obligations, which is bankruptcy or something close to bankruptcy, and these failures impact the real economy as a whole, we say that they're systemically important. So at this point, I could show you a little model, which is a model of what banks do. But I'm not going to show you a model because, first of all, you all know what banks do. And second of all, it only takes a few words to describe what this model really shows. I mean, basically, banks borrow money from depositors and other institutional investors. Some of it's long-term, some of it's short-term rollover funds. And they invest this in assets. Assets might be loans, might be money management businesses. And at the end of the period, these assets pay off. If they pay off well, there is added cash in the accounting, and this goes into equity values. If the assets do badly, then the equity part of the asset sheet is drawn down. Investors lose money. If they do especially badly, the bank faces liquidity issues as it tries to pay off its debts, or solvency issues if there is just not enough cash at all to pay these. So this is the leverage issue. And the question, of course, is how much leverage do banks take, or how much leverage should they take? And this little model of bank behavior essentially says, well, it's risk, the risk of bankruptcy, that constrains the amount of leverage that a bank can do. Whether this is risk that's borne by the bank itself or whether it's the creditors that supply the loans, it's really risk that restricts the volatility. And as a consequence, when volatilities are low, that constrains the leverage. And as a consequence, when volatility is low, risk looks low. When risk is low, leverage is not very risky, and banks are optimize their portfolio decisions will take on excess and increased leverage. And then, of course, when volatility goes back up again, which it seems inevitably to do, the asset prices decline, the capital ratios decline, measured leverage increases, and we see a banking crisis, which may lead to defaults, may not. So one of the issues is that in this little paradigm, I'm thinking that volatility has a role to play in how much leverage financial institutions take on. But a key issue is this short-term volatility or is this long-term volatility? And I think it's common to use the tools of risk management, which are basically short-run tools, to decide on the allocation of resources to assets which are essentially illiquid and longer-term assets. And a good example of that are the mortgage tranches that so many financial institutions loaded up on because basically they had no risk or essentially no risk in the short run, and yet when volatilities went up and the housing markets went down, the risk of these assets went up, and immediately there was a sale of these assets, a fire sale if you like, trying to sell them, and so it was really the change in the risk of these assets that made them into toxic assets and drove bank capital ratios to very low levels. Well, you could tell the same story about the European sovereign debt, that this was basically riskless or treated as riskless by regulators and risk managers for many, many years, and now all of a sudden it seems to have risk, so there is being a big negative to the balance sheets. I was also just in China, and I wonder whether there is something interesting to say about that. China is now struggling with the fact that their banks, which are all state-owned, have made all these loans to municipal governments. And many of these loans to municipal governments are non-performing. So is it possible that these municipal issues will actually have a same kind of a role in China that they've had in Europe and in the US? I don't know, but it's something I think we should pay attention to. So in any case, if it's risk that limits how much leverage financial institutions take, then we have to ask from a social point of view, is this the optimal amount of risk? And of course, if these are systemically important institutions, it's too much risk. So we have an externality which suggests, as we've discussed earlier today, but for slightly different reasons, that it makes sense to regulate these institutions to reduce their risk-taking. And although banks are complaining about this, one of the things that it seems like is not being really taken into account is if risk is reduced in a financial institution, then that actually will reduce the required risk premium that an investor might require, and therefore the cost of capital may not go up as much as some of the bank presidents have been claiming in the news recently. So how are we going to measure systemic risk? What I'm going to show you follows in the spirit of Charya, Pedersen, Philippon, and Richardson, who have developed a methodology for measuring systemic risk. And Christian Brownlees and I have adapted this to a time series context, so we can use all these cool time series methods and data sets that are so available to us to answer this important question. And what exactly is the question we're trying to answer? The question we're trying to answer is, if we have a future financial crisis, how much capital would this bank need to raise? And of course, if we're having a financial crisis, they may have a very hard time raising it from the private sector, and so they're going to come to the government. And the government is going to be faced with exactly this dilemma. Do we bail them out, or do we let them fail? If we let them fail, we get the global contagion that we've seen. If you bail them out, they say, okay, so we took too much risk, we'll never do it again. So that's the question, and we want to see if we can say something about this from a statistical point of view. How big should the capital cushion be so that the taxpayers aren't likely to be hit for the money? Now, some of you may feel like this question has the causality backwards. There's a question of whether the crisis causes distress in the firm or whether the distress causes the crisis. Which way is the causality? We're asking it, how much distress would this firm face if we have a crisis? It seems like we've asked the question backwards for systemic risk. But in fact, I think the causality goes both ways. From an econometrics point of view, we're talking about conditioning on an endogenous variable, and so they're jointly dependent. The capital shortfall of this bank and the financial crisis. If we have a financial crisis, there will be many institutions that face capital shortfalls. It is those institutions which contributed the most to the crisis, and that's the way we think about it. So the approach to try to estimate this is the expected capital shortfall given a crisis is what we want to measure. And this is, in fact, exactly what a stress test typically could do. And I think in terms of thinking about data issues and so forth, one approach to this is to look at all the balance sheets, all the assets of a financial institution, value these assets, value the assets of the financial institution, see what the cushion is, and try to figure out whether it's big enough. We're doing this in a rather different way. We're doing what you might call a top-down approach. We're going to use equity values of the firm as a way of measuring the value of its assets. So it's conceptually the same problem, but it's a different attack on the problem. So how are we going to estimate this? Well, the first step is to estimate the marginal expected shortfall, which is how much an equity holder in a particular financial institution would be expected to lose on a day when the market goes down a lot. This is a one-day event. So like Tuesday, the market fell a lot. How much would an equity holder in each of 100 financial institutions be expected to lose on that day? Second of all, we're going to extrapolate this to a real financial crisis, saying how much would equity holders be expected to lose if this crisis lasts 6 months and the market declines by 40%, for example. We call that the long-run marginal expected shortfall. And then thirdly, we ask, given the leverage of this firm and its capital cushion, will this firm have enough capital to withstand this decline in its equity values? As equity values go down, the capital will no longer be adequate to support the assets or the debt that it's got, so it may need to have a capital call, And that's what we're trying to measure. And we assume that there is a particular optimal leverage ratio that when it drops below that, they're going to try to raise capital. So here's the only time series slide I'm going to show you. I was tickled that the senator mentioned the autoregressive conditional heteroscedasticity model today. So here it is. So we say the market return is some volatility times a shock, and the return on a particular financial institution is its volatility times a shock, but these shocks are correlated. Both of these volatilities change over time, and the correlations change over time, and we estimate this daily so that we get pretty good up-to-date estimates of what the volatility is and what the correlation is. There are two shocks to this. One is the shock to the aggregate return, and one is a shock, idiosyncratic shock, and these are drawn from a joint distribution which is uncorrelated but not necessarily independent. Certainly not normal. It's fat-tailed. We use a bootstrap approach to drawing out of this distribution. So we've got a type of asymmetric Garch model for the volatilities. We've got a DCC model for the correlations. And we estimate this for 100 approximately financial institutions over a data set that goes back to, I guess, 2000 or maybe earlier than that. And that's it. Doesn't sound so hard, right? What do we do once we've estimated this? Well, we take these parameters and these distributions and simulate the next 6 months. 100,000 times we simulate the next 6 months. And we see for which of these paths did market returns fall 40%. These are the paths where volatilities went up. We got a lot of negative draws, a lot of tails in the draws. These were the returns which had the most negative outcomes. And then we look what happened to stock of each company in these bad scenarios. These bad scenarios often will have rising correlations because as volatilities go up, typically correlations go up. And we can calculate the long-run MES as the mean, actually we use the trimmed mean of the returns over this 6-month period. So we're going to calculate how much equity holders would be expected to lose in the next 6 months if the market as a whole drops by 40% over that next 6 months, okay? And once we do that, we can use that number to calculate what happens to equity values. It's 1 minus the long-run MES times today's equity values. And if we think that the prudential capital ratio is K, so then the shortage in capital is what we call S risk or systemic risk, is this prudential level times the debt minus 1 minus K times equity. And we're going to use 8% as something approximating what the BIS does. Okay. Then we put this on the web so you can see it. At the Volatility Laboratory, or VLab, we have a lot of these estimates of systemic risk for different financial institutions in the US. But what I'm actually going to show you today is some new results which, in fact, do exactly what I just described. They do the simulation. We have an approximation to this process that has been on the web, and you can find on the web if you go there. But what I'm going to show you now is an up-to-date simulation version of this model, which is going to tell us what the capital requirements of each of these financial institutions is likely to be if, starting today, we have 6 months of a major bear market, financial crisis. Okay, so what do these things look like? Well, here, for example, is a picture of what Citi's correlation has been with the broad-based market. And you can see in red there's the correlation, and here's 80%. So it's hovered, it's mostly been below 80%, but actually recently it's gone up to 80%. And this, since July is this vertical line, we're talking about August and September here. So we all know August and September were tough months, a lot of volatility, a lot going on. What we might not have known is that Citi was more correlated with the broad equity values than it had been before. In fact, the blue line here is the average of all the financial sector. So you can see financial sector as a whole has become more correlated. Well, if you look at the volatility, you see dramatically high volatility during the financial crisis of Citi. It actually, I mean, it was one of the most volatile financial stocks during that period. But also you see its volatility spiked up in August well above other financial assets. If you look at the long-run MES, this is how much you would expect an equity holder would lose in the next 6 months if the market declines by at least 40%. And so here you see we're talking about something approximately approaching 80% loss in value of Citi's stock from where it is today. Maybe 75% today, 80% in the beginning of August. And that is that's only slightly rivaled by what actually we observed in during the financial crisis. And what about the leverage? Well, Citi's leverage has come up by a little bit, but it's nothing compared to what we saw during the financial crisis when basically equity values approached zero. The ratio of assets to equity, well, went up to 300 here. That's a lot of leverage. But the main reason leverage changes is because equity values go down in this case. And so when we're done, we can calculate the S risk for Citi for each day over the last last 5 years, and this is measured in billions of dollars, and we're talking about like 125 billion now. So this, if we have a crisis like I've been describing, the claim is that Citi would need to raise another 125 billion of capital. Okay, maybe from us, maybe from the market, maybe you count on the new resolution authority and let it go. But that's the choices. So one of the things you see, of course, is that in 07, it didn't look so risky, but it really increased starting in the summer of 07, more or less when the financial crisis started. So there is a question of, do we know soon enough to be useful for regulators that there is a problem? And we're going to try to say something about that. What can we expect? Okay, well, that's one possible outcome. Here's another possible outcome. You didn't get that picture, right? Okay, so I've shown you Citi, but what are the other names in our list, and how systemically risky do they look? So here is what our top 10 looks like as of, I guess, yesterday. So Citi is third now. We have Bank of America, JP Morgan, Morgan Stanley, MetLife, Goldman, Prudential, Wells Fargo, AIG, and Hartford, the top 10. This is 10 out of close to 100. And these should be interpreted as the most systemically risky in the sense that they would need the most capital if we have another financial crisis. So is this a bad list to be on? Not necessarily. It means that you're big and important. And you would expect the biggest financial institutions are probably on here unless they've really got comfortable capital cushions. And that's kind of the question. Do they have enough capital cushion or not? And so I don't think, we've had some people say, you know, I don't want to be on your list, but it's, I think it's not such a serious issue. So is this list, how does this list compare with other kinds of measures you could have? Well, here is what the details of the website look like. Here's the S risk as a percent. Here's the S risk that I just showed you. MES, beta, correlation, volatility, leverage, and market value. And if you click on the top value here for any of these, you can sort them all by that variable. So here this is sorted by market cap, and you see the number one by market cap would be Berkshire. Then you see some of these that we think are at the top, but you see other firms like American Express that was 74 and United Health was 75. It's a different ranking, although some of the same companies are in the top 10. If you look at it and sort it by long-run MES, here's the long-run MES. It's numbers like 70 and 80%, but the highest one is actually Coventry Healthcare, followed by several of these other institutions that we probably don't think of as so systemically risky. And the rankings of these companies sort of range from 40 all the way up to Bank of America, but it's a different ordering from what we had. If you look and sort them just by leverage, it turns out the most highly leveraged institution is actually Hartford Financial Services. And again, it's a different set from what we have seen before. And finally, the question, well, it's not exactly finally, I guess, but one of the issues, of course, is how do we know whether this list is useful? Well, we can kind of wait till we have another financial crisis. I don't know how long we have to wait for that. Possibly not too long. But at least another thing we can do is say, what would this have said at different points in the past? And so we're going to look backwards and see what it was predicting at different points in time. And all these estimates that I've shown you are done recursively. So in the sense that the estimate for June of 2010 uses data only up to June of 2010. So this is like a real-time forecasting methodology. So let's take a look at January 31st, 2007. It's basically before the financial crisis started. And here we have Morgan Stanley, Fannie and Freddie, Merrill Lynch. You know, some of these are really kind of nostalgic, aren't they? Goldman, Lehman, J.P. Morgan, Bear Stearns. So this is a list of institutions that you would say, if you were given this list in 2007, we should be worrying about these institutions. Possibly we should require them to raise more capital because they will have a capital deficit if we have a financial crisis now. Now, these numbers are a lot smaller than the ones we see today for how much capital they would need. And that's because basically, first of all, the leverage isn't so high. Look at the leverage is 10 to 12, something like that. But also, the risk isn't so high. Look at these numbers. They're not 80 and 90% declines in their capital if we have a financial crisis. Volatility was low in these days. Risk was low. And so it didn't look like it would take so much money to bail them out, and actually probably wouldn't have required so much of a regulatory change to stabilize them. If you look a little further back, January 2005, well, Freddie and Fannie and Morgan Stanley are still there. Merrill Lynch, Lehman, Bear Stearns. It's kind of the same list. How about even further back than that? You go to January 31st of 2000. Who would we be worrying about at that point in time? JP Morgan, Morgan Stanley, Bank of America, Bear Stearns, Hartford, a few different ones, KeyCorp, Regions Financial, CNA. So it's a little bit different list, but it's not an outrageous list from the point of view of who would you like to have noticed. So, I think in many ways that looks pretty reasonable. There are some ways in which you might think it's not so reasonable. For one thing, Bank of America appears in 2000, but it didn't appear on any of the others, and yet now it's the top of our list. When did it get up there? And was that in time to have regulators do anything about it? Well, here's what the S-risk picture looks like for Bank of America. And one of the things you see is that it really was essentially zero before the summer of '07. But one of the things you may not remember is that Bank of America bought Countrywide. So it's sort of like your football team that gets a chance to either train its new stars or buy them. So Bank of America bought Countrywide and moved up the tables almost instantly. Then they bought Merrill Lynch, and that, I'm sure, launched them into the top spot pretty quickly. And I think this is actually Merrill Lynch coming online right here. How about AIG? AIG is another problem because AIG maybe was hidden to investors. Maybe people didn't really know how much risk AIG was taking. So would regulators have known, or did markets actually know? Well, again, we see its S-risk was zero more or less before the summer of '07, but it shot up quite rapidly in '07, and here's Lehman here. So it was very, and I guess maybe this is the TARP, but it was high all through this period. So AIG, maybe we didn't see it soon enough. Maybe regulators looking at the books could have seen it sooner, but this is not a bad early warning mechanism, and it's cheap and easy. You see also how much it's declined in the meantime. Well, this is what it looked like before Bear Stearns, and you see here's Bear Stearns number 12. It was not the most systemically risky firm by our measure at the time that it went bankrupt and was bought by JP Morgan. And it looks like if we had a financial crisis, you would say Bear Stearns would have to raise about $28 billion in capital. That's sort of remarkably close to what the Fed put in. I don't know whether it's meaningful that that's similar, but it's kind of interesting. So how about later? How about August 29th, 2008? So this is, 2 weeks before Lehman, 1 week before Freddie and Fannie. So here are the top institutions. Citi's on the top, JP Morgan, Bank of America, Morgan Stanley. Here are Freddie and Fannie straddling AIG. Where's Lehman? Lehman's down here at number 11. So we rescued Freddie, we rescued Fannie, we rescued AIG, we rescued Bank of America, we rescued Citigroup, we put some capital into JP Morgan. Merrill Lynch was bought. Goldman we put capital into. Wachovia failed. Okay, here's Lehman. It's next on the list, sort of. And I think you could only do so much, maybe. But it wasn't the top priority if this list is really a reasonable measure of the list. How about the stress test? I said this is like a stress test, but we actually have a stress test that the Fed did of 19 banks, and at the same time we had forecasts of what the capital shortage would be for these banks. The stresses weren't exactly the same, but we can compare these. So on 3/31 of 2009, this was our list. So Bank of America was top. It was also the top of the SCAP. Wells Fargo was second here, and it was fifth for us. Citigroup was fourth. Citigroup was third here. AIG, I think they didn't do AIG here. JP Morgan, we had a second on the list, and they have JP Morgan as no risk. And I think that's one of the interesting discrepancies. And, you know, as you go down here, you see SunTrust, Regions Financial, and so forth. Third, Fifth, Bancorp. It's not the same, but it's sufficiently similar that I think it's giving us a lot of information that if you're doing a stress test, you'd want to be looking at the stress test from one hand and this kind of measure with the other. And what about the total capital system shortfall? This is a picture which gives the sum of all the capital shortfalls of all these financial institutions every month. And what you see is, I think there's a zero missing here. I think this is 800 billion is what it looks like we're going to need. Actually, 836 billion is the number that it looks like we would need if we have a financial crisis now in order to rescue all the financial institutions. Compare that with like the 700 billion TARP. So are we in a situation like August of 08? Well, August of 08 was a little bit higher. It's actually $1 trillion was what this model says we would have needed. So the banks are not as weak today as they were in August of 08. Isn't that nice? But you can see how rapidly this has been increasing over the last couple of months. And this high volatility that we attribute, at least in part, to the European debt crisis, sovereign debt crisis, I think we also attribute it to U.S. political stalemate and the fact that we can't really manage our economy very well leads to high volatility in the U.S. market as well, and this high volatility increases the risk. I think this is a part of political risk which is probably underappreciated. So what happened over the last 2 months? Well, we could decompose this measure of S-risk. The change in this is the formula for S-risk. So the change in S-risk is basically 8% of the change in debt plus 92% of the change of this product, which can be approximated by the change in equity times long-run MES and the change in the risk times the equity. So which of these three sources explains the bulk of what I just showed you? So here are the change in S-risk in August. And you see they're all positive. The risk for the systemic risk for each of these institutions went up in August. Some by a lot. Bank of America went up by 21 billion. Equity continued to decline and contributed positively to the systemic risk. Well, let me just finish up here with a couple of implications of this. One implication is that we might want to set capital requirements so that in a crisis, capital doesn't drop below, say, 8%. So the question is, what should capital requirements today be if you want to have that as your criterion? So it would have to be higher, right? But the amount higher will depend on how risky and how much leverage this institution has. So actually, you can calculate this here. It depends on if this is really 8%, then you're going to divide it by 1 minus 92% of the long-run MES, and that's going to be a capital requirement which is higher than the 8%. If you think 4% is enough, then it would be something higher than 4%. Equivalently, we could think about the assets as being multiplied by some sort of a risk weight. And basically, Basel III has in mind some ideas of risk weights, but we get from here a measure of risk which is particularly appropriate for systemic risk. And that is, it depends on this long-run capital rate, it depends on the long-run MES, and so we should weight our assets, firm's assets, by this amount. The consequences are exactly the same, whichever way you write this, but in both cases, we're using estimates of how risky this firm's equity is to determine what is an adequate cushion for them to hold in terms of capital. In firms that don't happen to like this idea, each firm would have its own capital requirement. And that's, I think, an important aspect of it, because you would like each firm to know how to get off the list, to get its capital requirements reduced. What's the answer to that problem? Well, a firm can reduce leverage, reduce size, reduce risk, or reduce correlation. Any of those things will reduce its capital requirement. And if they do it, it'll get off our systemic risk list. The challenge that we're working on now is to figure out what would be a natural way to do this as a countercyclical policy. We obviously can't demand that financial institutions raise capital just before the crisis, because that's no better than demanding that they do it in a crisis. We have to have countercyclical capital buffers, and there are a variety of ways to think about this, but I think we probably have some interesting possibilities here. We can think about capital buffers as being countercyclical with respect to volatility. So when volatility is high, or when volatility is low, you build up your capital cushion. When it's high, you can reduce it. You could think about it being based on asset prices. So when the market is high, you build up your capital buffer. When it's low, you reduce it. Which one of these do you want? Maybe you want state-specific, firm-specific state variables, or maybe you want a macro variable. There are a lot of design issues in doing this. But one of the things that our environment allows us to do is we can simulate the behavior of any countercyclical policy and see how it works out. We can measure which countercyclical policy actually achieves whatever optimization goals we write down. So I think we're in an environment where we can actually say some interesting things about how to do this. And I will just say that we are working with a team in Australia and a team in Switzerland to do the same analysis internationally. European, Asian Pacific, about 700 financial institutions around the world. And we actually have some preliminary estimates of this, which we've not reported yet. But one of the things I can just tell you is that if you look at the S risks of the European banks at the moment, they're very high. This measure is going to tell us, I believe, that we do have a problem, and hopefully it will be solved, but its capital cushions look very thin. And you can see that reading the newspaper, but it shows up in the data as well. So let me stop here. I've sort of presented a really simple statistical methodology, but simple in some ways is good, I think. It focuses attention on how much of a leeway how much of a cushion do financial institutions really have, given the leverage and the value of equity they've got? And is that enough? Is that enough to protect the taxpayers or protect the economy? And I don't really think that this should substitute for any other method. I think it should be added to other methods, methods that actually look at what financial institutions do, have the potential of seeing things earlier, but they also have the potential of misinterpreting evidence, misinterpreting the valuation of assets, misinterpreting the risk of assets, misinterpreting how much risk there is in rolling over short-term debt, and all these kinds of things. So I think the goal here is kind of like a screening device or a comparison methodology that you could use in your regulation. So let me stop here and invite you to my favorite cafe, the Arch Cafe. Thank you.
Rob, we'll be entertaining some questions. Yeah. So who's first? Yeah.
Thank you. In one of your prior slides, you had Lehman like number 11, and you point out the government put money into the first 10 above. Could one also interpret that to say, instead of saying, oh, Lehman was so far down, maybe they shouldn't have, which they didn't, Lehman was so systemically important, had they put the 50 billion into Lehman, they may not have had to put the hundreds of billions in the other firms because they did not appreciate systemic factors.
Well, I mean, the firms above it all needed more capital, as you say. So these actually are additive measures in the sense that if you rescue one, at least by our measure, it doesn't save the others. But there might be a, okay, so you're saying maybe if you optimized your capital, it wouldn't be just going down the list from the top. Interesting point. Anything to say on that, Matt? Anyway.
It's fine to save Lehman, but then Citi was failing, and Bank of America were failing, and Merrill were failing, and AIG were failing, not just because Lehman was failing, they were failing because they had the same problems that those institutions had. So I think allowing them to fail may have made things worse, but it didn't mean that it didn't imply then that you didn't have to save the other guys.
I think that the implicit in the way we do the list is that every dollar of capital shortfall which is allowed to fail is sort of equally damaging to the economy. And you might say that's not a correct assumption. Yeah.
Mark Miguel from Richmond Fed. So I guess that related point to the last is that I believe your measure analyzes how much it would cost to save that institution.
Right.
It doesn't really look at how much harm to the system that institution would do,
right,
which would be a different
right
thing. So, I mean, have you explored other types of approaches that
right.
would look at that different question?
So we don't have anything to say about that, except that our view is that that there are externalities from the financial sector, so that $1 of failure produces many dollars of externalities as the financial system brings down the rest of the real system. But that doesn't mean necessarily that every dollar is equally powerful in that direction. Yeah.
Bob, thank you for the talk. If I'm running a bank under a regime like this, can I engineer a good score?
So I suggested some ways that you could engineer moving down our list by divesting yourself of divisions, by diversifying your assets, by other sorts of things. Now, I believe that banks probably try to control their stock price today, but I don't think they're very effective at it. And I think most CEOs complain all the time if the market doesn't correctly value them. So I think that in many ways firms do as much as they can to control the stock price. What about the volatility of the stock price? Can firms control the volatility of their stock price? Maybe by not writing down their assets, they think they're controlling the volatility of the stock price, but ultimately it comes out and investors punish them for the lack of transparency. So I don't know that there is very much that the firm can do to engineer this, and I think it's actually one of the strengths of this methodology compared with, having bank regulators that you try to convince that this asset's really a good, sound asset and doesn't have any risk.